So the Cromford Report just admitted they are worried. And if they're worried, I'm worried. Most of the time, they are not super concerned about the things that we're seeing in the market, but they finally said they are worried that something abnormal could be going on in the market. So we're going to look at that today. Plus, home builders are saying that all of these rate buy downs are getting pretty tough to continue to do to incentivize buyers to buy their homes. So we'll talk about what that looks like and what's happening on the new build front. So why is the Cromford Report worried? Well, we're looking at our active listings, and you can see on this chart here, we have 2014, 2016, 2023, and 2024. And for 2014, 2016, we have the same seasonal pattern that took place. This is very traditional for what we see in the Phoenix market, where we see an increase in active listings at the beginning of the year. A lot of that gets eaten up by all the buyer demand in our spring selling season. The summer, we see lower active listings on the market. We have a little rally in the fourth quarter, and then it tapers off. And you'll notice that 2023 was not that seasonal pattern. However, all we saw last year was a decrease in our active listings through the year. And then we had that same little rally at the end of the year, and it tapered off. This year, however, we have seen this increase in active listings pretty much all year, with the exception of like June, July-ish, a little bit of fluctuation. But if we look at where we started at the beginning of the year to, where we are today, it's a clear trend line from that has increased from the beginning of the year. And I had mentioned this a few, maybe 12 weeks back now, that we saw this uptick in active listings in August, which is not typical for us. It's usually not till September, October that we start to see our little increase. So that started early, but it's been a very consistent increase in active listings over that time. And the Cromford Report has said, we need to be watching these active listings because this is getting to be a little bit abnormal. Now, if you see these seasonal patterns here, it's about this time that we start to taper off in terms of our active listings. Yet, that's not happening. We actually went above our 2016 levels last week. And so this is why the Cromford Report is saying we're kind of worried that something abnormal could be going on. Now, my thoughts, Cromford Report is usually right about what they say. So I'm going to say maybe there is something abnormal going on. However, I do believe I said a few weeks back that we would see an increase in inventory after the election because of pent-up supply, and maybe that's what we're seeing. I know I personally spoke with a lot of folks who are waiting to list their homes or take any action real estate-wise, including listing their home, until after the election. So perhaps this little spike over the last 2 weeks is that pent-up supply that's finally hitting the market, and we'll start to see this normalize. However, if we do go into the new year with an increase in supply in active listings, and this doesn't taper off, and we continue to see active listings climb, we are going to be in a buyer's market pretty solidly. We will likely start to see prices coming down. So TBD on what that looks like. Of course, this could taper off. It could continue to climb. And is there something abnormal going on? We'll find out. But as I said, Cromford Report is usually right. So the fact that they're starting to say that has me a little bit worried. So why are we seeing these active listings pile up? Well, we are starting to see more listings hit the market for sure. However, we also don't really have a whole lot of buyer demand going on because in part to mortgage rates. So is it a good thing to be a seller right now? It's traditionally not the best time of year to be a seller, and the fact that we're seeing this increase in inventory, that is more competition for you. It's more advantageous to be a buyer at this point in time. Caveat, we don't know where the market's heading either. So with this increase in inventory, I would keep a close eye on that. Now, like I said, mortgage rates are playing a role in decreasing this buyer demand. So where are we at with mortgage rates? Well, let's take a look here at this graph. We're around 7.05% as we ended last week. Again, I don't want to put salt in the wound, but you can see the big change since September all the way up to 7%. We thought we were in a good place here. We thought we were going to stay here. We were like, yes, 6, maybe 6.5. This is the new place we are going to live. But we were wrong. We were very wrong. So what's going on with rates? Well, rates stay flat as Trump's second term comes into focus. This article talks a little bit about kind of the broader scope of what is going on with mortgage rates. They're saying that after a 6-week climb, rates have leveled off. Yay, at least they leveled off around 7. We didn't hit 8. But they're saying the Federal Reserve's 25 basis point cut last week, and this was written last week, so we're talking 2 weeks ago, had little effect on mortgage rates because the move was widely anticipated, and we talked a little bit about that. Of course, mortgage rates aren't directly affected by the Fed's cut. They respond more to the expectations about the central bank's future moves. They're saying traders are now considering what the Fed might do in December, with more than 76% currently expecting an additional 25 basis point cut next month. Even as rates stay in the high 6% range, applications to purchase a new home rose 2% from a week earlier, snapping several weeks of declines, according to Mortgage Bankers Association. So they're saying that there is some more buyer activity coming out regardless of where these rates are. I think that, again, going back to the election, I think we are seeing some of that pent-up demand as well. A lot of people were just holding off until the election to decide or actually take action on their real estate goals, whether it be buying or selling. So I'm not surprised to see that we have a little bit more going on the buy side, regardless of where rates are at. So it sounds like for the rest of the year, we're probably not going to see a whole lot of movement in mortgage rates. So if you are a buyer, kind of holding on, hoping that you're going to see something better before year's end, my guess is it's not likely. But you never know. And we'll see how things change after the next Fed meeting as we get into the new year. And of course, there's a lot that could go on in the economy that could shift where mortgage rates are at. Now, I said that home builders have expressed some fatigue around offering incentives, and want to share this article with you. Before I get there, if any of this information is helpful for you, make sure you hit that subscribe button. Consider sharing this with someone who may find it helpful as well. The ballooning cost of home builder rate buy down incentives. You guys, builders give huge incentives today, like a lot. And this article is talking a little bit about that. They're saying that some home builders are spending anywhere between $40,000 to $60,000 on a $500,000 home to help bring interest rates down for home buyers. And in the past, they used to see like maybe $10,000 to a rate buy down. So this is really eating into their margins. They say that many builders feel that it's unavoidable and even mandatory to offer these rate buy down incentives if they want to maintain market share. And they want to put an end to the costly incentive, but that's going to depend on how soon mortgage interest rates will be dropping. They even say it's kind of mind-blowing the amount of money we're spending on rate buy downs. However, apparently they are not in dire straits. They're saying this is very different from the Great Recession, when they were basically in the red on every house that they sold. And they are hoping that they can kind of ease back on these rate buy downs in the future as rates continue to decrease. Now, as we just read about and just looked through rates, I don't know that rates are coming down all that much anytime soon. We may be lucky to be at 6.5% and very lucky at 6% in the near future, in my opinion. So will builders continue to give those incentives at those mortgage rates? I don't know. Is this coming to an end? It doesn't sound like they can afford to allow it to come to an end, but how much longer can they sustain this if they're spending $40,000 to $60,000 per home buyer in offering incentives? They say about 90% of their customers, this is according to one builder specifically, are using the rate buy down incentive, which makes sense. Why wouldn't you if you're financing? And until we start to see those rates come down and become more affordable, I don't see it ending. It's what's required right now. I'm not long-term worried because of the incredible job growth and economy we've got here. We've got to get through this weird period with interest rates. Thought that was interesting, wanted to share that. So if you are considering new construction, just know they're still offering those incentives, and for lack of a better term, feel forced to do so in order to maintain market share. In the description, I have a link to check out a list of new construction homes, so make sure to take advantage of that if you're interested. Now, we can't predict rates, but the National Association of Realtors chief economist, Lawrence Yun, who I've talked about on this channel before, has given a forecast for next year, and he forecasts a 9% increase in home sales for 2025 and a 13% increase for 2026, with mortgage rates stabilizing near 6%. I hope he's right. Based on what we were just talking about, I don't know if he's right. Stabilizing near 6% to me feels a little aggressive. I'd feel more comfortable saying 6.5%. And also an increase in home sales, I can see that happening because we're at the lowest number of home sales since 1995. We had that same stat last year, and this year we are actually lower than that. So an increase would be welcomed. An increase does seem reasonable to expect based on where we're at today. In this article, Lawrence Yun is citing that since the beginning of COVID, we have seen record high payroll employment as of September of 2024, and states that when more people work, they have the capacity or they're in a better position to buy a home. So he feels confident in where we're at with the economy in order for more buyers to get out there and purchase homes. As it relates to mortgage rates specifically, he's saying, per my forecast, unfortunately, we will not, related to seeing rates back to that 4% last time Trump was in office. It's more likely that we'll go to 6%, and that will be the new normal, bouncing around 5.5 to 6.5. I don't know. Again, I feel like 6.5 is a little bit more of a reasonable expectation. He says we can expect 6 to 8 more interest rate cuts. He also gave advice to the Federal Reserve on when to make the cuts, and he said do it in January rather than December. He expects there will be 4 different rounds of rate cuts in 2025, and also talked about how we have to have more supply. We're trying to do everything we can to boost supply. Well, apparently in Phoenix, we're already starting to see that. He says maybe the worst is coming to an end. I think there's going to be a roughly 10% boost of existing home sales in 2025 and 2026. So everyone loves to give their forecasts and their predictions towards the end of the year. I love to share that so we can see what actually happens as we get into the new year. Now, I mentioned that we are in a buyer's market, and we totally are. Anything below 90, according to the Cromford Market Index, is considered a buyer's market, and here we are at 87.5. As I was sharing before with our active listings, the more those climb and the lack of movement on the side of demand is going to put us more in a buyer's market. So our supply has climbed to 87.8, meaning that it is only about 13% below normal. And this was at 76 and the low 70s not too long ago. So we have definitely seen this increase in supply throughout the CMI. And then as far as demand, we're sitting about 24% below normal for demand. Again, not really moving all that much, not increasing all that much while we continue to see supply increase. So those two factors put together are putting us in this buyer's market of 87.5. As you all know, every city behaves a little bit differently, but we're seeing a very big number of red arrows on this chart. So every city, for the most part, except for Chandler, Cave Creek, Phoenix, Avondale, Tempe, and Peoria, all of